Hey everybody, Dave here, Hidden Freedom Investing, and today we're going to do a Fundrise update for Q2 of 2020. So I got paid some dividends, plus Fundrise also put out a message. So we'll go ahead and go through that, and we'll also look at the performance for the year to date for 2020. So let's go ahead and get started. All right, we're logged into Fundrise here. This is my account, and obviously I've done a lot of videos on Fundrise, so if you want to go ahead and take a look at some of those videos, you can basically pull up the Fundrise playlist. I'll put it up here if you want to take a look at that. So this is the main screen that you get, the overview page here, $16,475. We did get paid some dividends for Q2, so let's go ahead and click on the dividends down here. And then there's the dividend there. So July 9th, 2020, I got paid $129. And when I got paid that, I pretty much thought, like, what's going on? Why is it so low? So we're gonna go over that. But right now it looks like, Q2 is running a little behind, or I guess it's running a little lower than previous quarters. And we're in a pandemic, so what do you kind of expect? So we'll look at the performance here in a second, kind of get an idea of where possibly the performance is going to be for the end of the year. So last dividend in April was $224, dividend before that was $285, and then the dividend before that. And obviously, I've increased the account value over time, so some of these dividends, it's not just like I didn't have $16,000 when I got this particular quarter. So yes, I got $129 and that got reinvested. So if we want to take a look up here in transactions and looking at the contractions, I'm not giving birth here, folks. There's the actual reinvestment there of the dividend. So it went into, and I'm in supplemental income plan. I've done videos on why I selected in the supplemental income plan. So if you want to take a look at that one, I'll just put that video up here. So so the Q2 2020 dividends got reinvested in the income REIT 5, and it got reinvested into the balance eREIT there. So which looks good because I'm trying to avoid that national E fund, and then so I don't have to get that stupid K1. Although I already got some money into the national E fund, it's gonna be a while before I get that out. So I'm still stuck with the dreaded K1. So going back to the portfolio, or let's actually look at the actual transactions still. So looking at the transactions, I've been sticking in cash pretty much every month or so. So there's April 21st, May 1st, May 27th, June 8th, June 30th, June 9th, July 9th, and there's a pending one that's not showing up in here for another $50. So what that is that's me draining my LendingClub account out. So every time I get 50 bucks in that account, I just take that 50 bucks out and then stick it in this account. So part of that is just reducing some of my tax documents. I'm trying to get rid of the Robinhood account, trying to get rid of the LendingClub account, trying to get rid of the M1 account. So just to reduce the tax documents, that'll get rid of 3 documents right there. And last year I had 18 documents. So just need to get rid of those. So that's the whole thing about getting rid of or pulling that money out of the LendingClub. So let's look at the portfolio here. So looking at the portfolio here, these are all the eREITs or REITs I'm invested in, and also that national E fund is right there. So if you're not, or if you're familiar, if you're not familiar, if you are new to Fundrise, when they issue their tax documents, they'll give you a 1099 DIV for every single one of these REITs, okay? And a lot of them have a different address on there because they're under different LLCs or something like that, different REITs, right? I'm not sure if it's an LLC, but the National E Fund might be under a partnership. So yes, they pretty much put out a 1099 DIV for every one of those. So the more of those you're in, the more documents you got to insert into, Quicken or whatever you use, TurboTax or whatever. I use TaxAct. So those are all of the eREITs made up in my portfolio, and I do have that National E Fund there. which you get with the plus accounts. So if you're not, if you think you're getting something out of the plus account, that's what you're getting. You're getting those National E Fund or those single family homes. So if you're enjoying this Fundrise video, go ahead and like and subscribe and hit that bell notification. Let's go ahead and take a look at the performance here. So the performance for Q2, so we're just gonna kind of go through these. Here's Q1 here. So Q2, this income eREIT performed better than the previous quarter, so that's good. The growth eREIT performed worse, and East Coast eREIT, 3% out of that, really good. Heartland eREIT, minus 1.8%. That's crazy. So I looked in that earlier just to try to get an idea of what type of investments they had in there and all that stuff, just to kind of get a breakdown of it. So you can just click on that and you can kind of get, it's got 15 projects in it, and then it'll list them all down here. So you can kind of get an idea of what projects are in there. There's a lot of debt. So equity, debt, equity. I'm not really sure why that one performed a little bad, but it is what it is. So we're in the middle of a pandemic. So let's go back to the performance here. All right, so and then we had 0.9, 0.7, 2%, 0.5, 2.6, 4.4. That's a huge one. So let's see what's in that one. Growth eREIT 3. It's got 5 projects in it, and so a lot of renovation. They're all in renovations except for this one here. So that's interesting. So you'd think that those ones wouldn't be paying, but the thing is some of these projects, there could have been projects that actually got paid back. We'll kind of look at that here in a second. So. And then for a total weighted average of 1.4% for Q2. So that's not too bad. We got 1.3% for Q1. We got 1.4% for Q2. And I mean, if that stayed up 1 point something percent, we could get about maybe I'm thinking maybe 5 to 6% out of the platform for this year. Now last year was 8%, a little over 8% is what I got. So if we look down here for 2019, 8.2% is what I got for last year. So I think this year we're on track for probably around, I would say, anywhere from 5 to 6.5%. And assuming things don't get worse, of course, because I know evictions and foreclosures could be happening and all that. But I mean, obviously they're very Fundrise is very diverse, but so. I'm still happy with even 5% given what's going on. So if we go ahead and look here at the notifications here, there's a lot of projects that got paid back recently. So let's just go back to overview. We'll kind of look at them from here. So there's a project that got paid back on July 17th, and today is July 17th. So that one got paid back. And July 15th, another project got paid back. So there's our dividend. We're going to go over this investor update here in a second. And then June 29th, another project got successfully completed. And then June 26th, that was the progress report. And then we had another project get updated here June 23rd. And then we had, I pretty much went over this update last video, so we'll kind of stop there on these updates. But so a lot of projects had been paid back, so my projects have been reduced to 146. So that could be part of the reason why the returns are slowly going down, is because a lot of the money is just sitting there and needs to get back and put into new projects. So projects have been reduced, so debt has gone down. So let's go ahead and pop up that, let's see here, investor update. So first half of 2020 performance and analysis. This came out on July 1st. Despite the unprecedented disruption in the economy caused by the beer virus pandemic, the Fundrise portfolio has performed well over the first 6 months of the year. I would say so, so we got 3% so far. And here they're kind of just showing you a comparison here, Fundrise versus the stock market and REIT ETFs. And looking at the VTI, which is a very common Vanguard index. One of my favorite indexes is VTI. So, and this was on July 1st. Obviously, the market's come up since then for the last 16 days, so it's not quite minus 4.5 or 4.9%, excuse me. And here's the Vanguard ETF VNQ, which I've invested in some other accounts. I've kind of done videos on those as well, but so that's down minus 15%. Like I said, it may not be down minus 15% as of July 17th, but as of July 1st and whenever they made this particular update, it was down minus 15%. So we're up 2.4%. Matter of fact, my account's up 3%. So I'm doing a little bit better than what they actually had here as well. And that could be also just because I'm logged in 16 days after the update as well. So outperformance first half, so they outperformed the VTI by 7% and they outperformed the VNQ by 17%. That is pretty impressive. So key takeaways: the Fundrise net platform return for the 6 months of 2020 was approximately 2.4% in comparison to the minus 4.9% for stocks VTI, and which is the overall stock market index, by the way. So and then minus 15% for public REITs, the VNQ. So the VNQ is made up of a bunch of different REITs, and it's a really good ETF if you want to get a lot of exposure to a lot of different industries and sectors. So this top line performance is supported by strong fundamentals, with a number of our stabilized projects actually experiencing positive rent growth in spite of larger economic contraction. Okay, that's good. So that means they're, probably not getting a lot of people moving out early, or they're not getting a lot of vacancy with a lot of their long-term apartment complexes. So we attribute this success primarily to having maintained the disciplined value and investment approach led by our most active strategy of owning and lending to affordable apartment communities in growing cities throughout the Sun Belt. That's probably all your major cities out there that have a lot of jobs and booming economy, like Seattle, Denver, I don't know if Dallas, what's another one? Probably New York, Chicago, parts of California, of course. We believe there is still potential for hard times ahead because of the stability exhibited by a broader portfolio over the last 6 months. We have chosen to resume normal operations of the redemption programs and expect to ramp up new acquisitions through the rest of the year. Okay, so that's good. So like I said, I've had a lot of projects pay back. It looks like they're gonna go ahead and start investing in some new projects again. So that'll get a lot of the money that's probably sitting on the sideline in my account back to working again. And good news for you people that don't like Fundrise and want to get your money out of Fundrise, that looks like they've resumed the redemption period. So if you do try to get your money out prior to 5 years, you may have to pay a penalty for that, depending on how many years early you try to take it out. It could be 3, 1, 2% or something like that. So if you're looking to get invested in a Fundrise, I would, just know that this is a long-term investment of 5 years plus, okay? And scrolling down, we're gonna have a little bit of a graph down here we can kind of just look at, get an idea. Latest change in net asset values, the kind of a breakdown of their equity investment. So apartment stabilized, commercial stabilized, the development, the rental for sale, and the miscellaneous equity. I'm not really sure what that one is, but that kind of gives you a breakdown there. And then this is kind of interesting. Occupancy, May for last year was 95.1, and then for this year was 93.9. So we did have a little bit of a decline there. So that kind of makes sense. I mean, there's been a lot of, people probably had to move back home into their basements or parents' house or something like that. Delinquencies, Jesus, sound like freaking Jerry over here. Delinquencies, May 2019, 1.5%, and May of 2020, 5%. So that has to do with your evictions being postponed, and all the money coming from the Fed, or what do you call that? The money going out, the stimulus package. The stimulus package. So they had to people probably not paying their rent on time and all that. So it's most likely probably rent. It's probably not has a lot to do with the other projects they're working on. But rent growth obviously has gone down as well. So I mean, given the pandemic, the severity of it, we're really not being affected too much with Fundrise. We're still getting a return out of it compared to the VTI, compared to the VNQ. We do see a little bit of decline here. You know, you compare it against your favorite REIT, Realty Income, which is seeing a decline of about 80, I think they saw 85% of people paying their rent. So, and they're mostly all commercial. So I'm not really going to go through the rest of this stuff. If you want to get this information, you can either log in or you can look at this URL up here. So that's my account. I got a little bit of appreciation out of there, got some dividends out of there. So we'll go ahead and invite a friend here. And I know over the last couple of months or so, actually, matter of fact, since the last video or so, we had a few people sign up. So I think there's like a couple people that signed up. So thank you very much for using that link. If you don't have a favorite YouTuber, or you don't have a friend with a Fundrise account or something like that, then feel free to use my link right here. I'll put it down in the description as well. You'll get 90 days of free advisory fees. Okay, so thanks a lot for everybody that signed up through my link. So hopefully you got some value out of this video. Let's go ahead and end this video. I'll probably do an update in September because that'll be my 2-year mark. So until then, go ahead and like and subscribe. We'll see you next video.